The property is located in Woden, which is one of the central nodes of Canberra. Canberra has 5 nodes, which is Civic, Woden, Belconnen, Tuggeranong and Gungahlin. BowesSt's a B-grade office building with about 12,600 square metres of net lettable area. It also has a full floor of car parking on level 1. QE was attracted to the BowesSt transaction largely because of the low rate per square metre that we were able to buy it on. It was a discount of over 50%. We only paid $1,100 a square metre and that's over the net lettable area. That doesn't even include the car park. So we paid $14 million for this property, and when it last traded in 2006, it traded for $37.5 million, and in 1998 it traded for $38.6 million. Our main target tenant is a government tenant. Government tenants require a high neighbours rating, minimum 4.5 star. We want to be right at the higher echelon of their green lease requirements. We purchased BowesSt from a receiver, so it was a receivership. Canberra is not that attractive to funds at the moment. They're all cutting and running because there's a lot of capex work and repositioning or regenerating required for buildings in Canberra, and that's really one of the markets that we want to be involved with, because if the funds are letting go of property down there, that's the potential for us to buy well, and we certainly aren't scared of getting in and getting our hands dirty to regenerate these assets. The occupancy of the property is just under 70%, so we'll be looking to market the balance of that space for the period up until November 2013 when the government leases expire.
Despite the relatively high vacancy rates in Canberra's office buildings over the last few years, we continued on to purchase the property after analysing the vacancy rates in office buildings by breaking it down into segments, into A grade, B grade, C grade and D grade office buildings, as well as the office buildings that have been built around the Canberra airport. We
wanted to delve a bit deeper in terms of the vacancy rates in Canberra. Canberra has 2.2 million square metres of space, but we've looked at the regions within Canberra and the airport has high vacancy, about 36% vacancy.
The government is only really interested in going into A and B grade buildings. So we eliminated the C grade and the D grade buildings and the vacancies in those segments, as well as the vacancies at the airport office buildings, because most of the government departments would not really be interested to move out into that location. So in analysing the A and B grade vacancies, we determined that the overall vacancy for A and B grade in Canberra was just on 5%, and the actual vacancy out of just under 200,000 square metres of A and B grade in Phillip, where the BowesSt building is located, was 4,400 square metres, of which 4,000 of that 4,400 square metres was in the actual building that we acquired.
But if you drill down into it and exclude properties are really not going to be leased by the government, so that's C grade and D grade assets, and also exclude a market which is the airport, which really isn't as desirable as other markets for most of the government tenants, you really start to get a vacancy rate that's very low. The building's currently 68% occupied by the Department of Human Services. They have a lease that runs until the end of November 2013. So we've got adequate cash flow over the next 18 months to regenerate this asset, reposition it in terms of finding that next tenant. So our number one risk here is obtaining a long-term lease from a replacement tenant over the asset. In our IM we've allowed for a vacancy period of 2 years, and based on the research we've found that is well in excess of what should be required, and we're already going out and being very proactive to find that tenant.
Accordingly, we didn't feel that we were in a position to pay annual distributions to investors on their cash investment. This is different to previous projects where we've always paid out an annual distribution.
The rents are currently at the low end, if not slightly below market. That's in its current configuration. But when we regenerate the asset and reposition it, it will have a big rental uplift. Part of the value add for this property and the repositioning is going to involve construction, albeit fairly light works. It's still going to involve construction contracts for the services and the upgrades. So anything we do, we'll be looking to de-risk that through guaranteed fixed price contracts, so we're really not exposing ourselves to the risk that there'll be a cost blowout. And so, that was a real driver for us to want to get involved with this asset and regenerate it into that A and B grade stock.